Good morning dear learners, and welcome you all to the next lecture of my course on financial literacy. This is module number 9, concept related to the income tax return. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, Banaras Hindu University, welcome you all to the lecture number 43, where we will be going to discuss about the Public Provident Fund. In the previous sessions of this particular module, we had discussed about the income tax return filing procedure, and we had also known about the various types of tax saving schemes of the Government of India in which an assessee can invest and they can minimize their tax burden. In the previous lecture, we had discussed about the National Savings Certificate, and in this particular lecture, we'll be going to take up one more investment avenues where any investor can invest your money and they can have a stable and regular source of income, as well as they can also claim for the tax deduction under the Income Tax Act 1961. So let us have a look that what will be the part of discussion in this lecture. So here we will be going to discuss about the concept of Public Provident Fund and its features, and we will be going to understand what are the various documents that are required for the purpose of opening a Public Provident Fund account. Then we will be going to understand the various aspects related with the Provident Fund, that is the types, tenure of investment, minimum and maximum investments required in the PPF account, and we will be also going to understand how we can get the approval for our loan against the PPF by keeping it as a collateral security, and we will be also going to understand the procedure of withdrawal of the investment from the PPF account. We will be also going to discuss about the drawbacks of the PPF account and the process of opening the PPF account with the help of online platform will also be discussed in this lecture. And we will be also going to discuss the process of transferring the PPF account from one bank in the another bank for the purpose of ease and convenience of managing your accounts well. So now let us have a look on the concept and meaning of the Public Provident Fund. Basically, the Public Provident Fund scheme is a scheme launched by the Government of India in the year 1968 for the purpose of giving the investor a long-term investment option. This fund was first implemented in the year 1968, and it aims at pooling small amount of money from the different contributors, that means the prospective investors who belong to the low income or middle level income level of this society, and it guarantees them a fixed return by investing their money into the PPF account. So basically, in the form of interest, the Public Provident Fund gives the amount of return to their contributors. So one can choose the Public Provident Fund as an investment option because it may be very safe as well as it will provide them risk-free return. One of the major benefit of the Public Provident Fund is also that it qualifies for a deduction under Section 80C of the Income Tax Act up to rupees 1.5 lakh rupees per annum. That means if you invest or contribute an amount of rupees 1.5 lakh rupees per annum in the PPF account, then at the time of calculation of your total taxable income, you can deduct an amount of the contribution that you have made in the Public Provident Fund. Through a PPF account, you can also accumulate your fund for future, as there is a lock-in period. While it may not offer you higher return as compared to the other investment option, but it provides you stable and secure source of income and also offers you compounding benefit of the investment. So on the interest amount also, you get the interest that helps you to accumulate the wealth by investing your money into the PPF account. Now, let us understand the various aspects related with the Public Provident Fund. If we talk about the eligibility criteria, any resident Indian can open a PPF account with any of the bank. Partial withdrawal is allowed to the investor, but only after a time period of 5th year. So there is a fixed lock-in period in the public provident fund of minimum of 15 years, but after the 5th year you can partially withdraw your investment from the public provident fund. The public provident fund can also be used as a collateral for getting loan from the banking companies or other financial intermediaries. So from the 3rd year to the 6th year, the loan facility can also be taken by the banking companies by keeping your public provident fund account as a collateral security. The contribution amount in case of the public provident fund may be a minimum of rupees 500 rupees per month and up to rupees 1.5 lakh rupees per annum at a max, because only this amount of the investment can give you the tax deduction under the section 80C. So tax treatment of this particular 1.5 lakh rupees of investment is that you get a deduction of rupees 1.5 lakh under section 80C triple E category. Then if you talk about the mode of investment or deposit frequency, up to 12 deposits in a year can be made in the public provident fund. So on every month you can contribute on a monthly basis, on 6 monthly basis, on a quarterly basis, or at once also you can deposit the amount of 1.5 lakh rupees in the PPF account, or you can also make some auto deduction from your account in the 12 different annuities from your bank account. It has a lock-in period of a minimum of 15 years, so that means the total principal amount can be withdrawn only after the completion of the lock-in period of the account. Then it gives you guaranteed returns from your investment. That means a steady return will be offered to you over the period of investment from this particular investment avenues to the assessees. So these are the various aspects related with the public provident fund. Now let us understand some special features of the public provident fund. So if we talk about the special features, it is a government backed scheme. That means PPF schemes are backed by Government of India, and it also qualifies a tax deduction of a minimum amount of rupees 1.5 lakh rupees under section 80C per year. So it is a government backed scheme. That means it gives you sense of security and it also offers you regular return from your investment. It is safe and secure as it is government backed fund. That means this investment option is very much suitable for all those investors who are of risk averse nature. That means they do not want to take risk with the investment of their fund into the market. It gives you guaranteed return. PPF provides you fixed return in the form of interest, offering you regular source of income. It may be lower as compared to the other investment avenues, but it gives you stable income until the maturity of your investment in the PPF account. Next is it gives you tax advantage. The very special feature of the PPF account is it gives you benefit under the section 80C of the Income Tax Act. Additionally, the interest that is earned in the PPF account and the maturity of the account will also be exempt from the Indian Income Tax Act under section 10 of the Act. That means the principal maturity amount and the interest earned in this particular investment is also exempted under the section 10 of the Income Tax Act. So it increases your saving as well as it increases your wealth. Now the next feature is loan facilities. With the help of the PPF account, you can also avail the loan facility from the bank from the 3rd year of the investment to the 6th year of the investment. So there is a specified time limit in which you can get the loan facility with the help of the PPF account balances. Now let us understand what are the various types of documents that is required by the investor to open a PPF account in a bank. So you need to first fulfill your KYC documentation with the bank for the purpose of your identity verification. So you need to provide Aadhaar card, voter ID card, driving license for completing your KYC documentation. You also need to have a permanent account number, that is PAN number, with the help of which you are also eligible to file your returns at the due time. So PAN number is required. A proof of the residential address is asked by the bank to be deposited at the time of opening the PPF account. You also need to give a nominee declaration form. With the help of nominating a person, you can assure that in the event of your demise, any other cases, your money will be given to your legal heir. So nomination declaration form gives you a chance to nominate your legal heir for the purpose of receiving the money in the case of your death, and passport sized photograph. So these are the minimum documentation that is required by an assessee for investing their money into the PPF account or opening their PPF account. KYC documentation, PAN number, proof of residential address, nominee declaration form, and passport size photograph. Now let us understand the investment tenure. If we talk about the investment tenure, the PPF account has a minimum of lock-in period of 15 years. That means in such kind of investment, the liquidity of the investment is very low, and that is why you may not feel it as a suitable option for the investment. So during this particular time zone of 15 years, maybe in certain cases partial withdrawal may be allowed to the investor, but full withdrawal is not allowed to the investor during the time period of 15 years from the date of the opening of the account. After 15 years, the tenure can be extended in the block of 5 years as per the choice of the investor. So those investors who do not want liquidity of their fund and want to invest their money into long-term investment for accumulating their wealth, they can choose this particular investment avenue, and they can give directions to the bank to block the money for again 5 years of the time period. So on the investor choice, the tenure can be extended in the blocks of 5-year time period for the tenure of investment. Then comes the minimum and maximum amount of investment. So if we talk about the minimum level or the maximum limit of the investment, so the minimum may be 500 rupees per year. That means you can invest rupees 500 in a year into the PPF account for the purpose of saving your small amount of earnings, whereas at a maximum you can invest 1.5 lakh rupees per annum into the PPF account. So it can be made in a lump sum deposit of the amount of money into your PPF account, or you can also create 12 equal annuity payments to the PPF account from your bank account. The contribution must be made every year for the purpose of keeping your PPF account alive. That means in case if in any year you do not pay the contribution in the PPF account, you will be charged for the penalties and fine from the banking authorities. Now let us understand the eligibility criteria that the investor need to fulfill for the purpose of opening a PPF account. So only resident Indians of India can open a PPF account. That means the other type of assessee that we have discussed, they cannot be capable of opening the PPF account, such as the not ordinarily resident or non-resident or NRIs. They cannot open the PPF account with the bank. Minors, those who are below the age of 18 years, they can also open an account, but they need to have a guardian or parent for the purpose of opening the PPF account. So through their guardian or parent, they can open public provident fund account with the banks. The NRIs and HUF are not eligible to open any new PPF account. However, if they are having any existing account that is held before changing their status to NRI or HUF, then that account can remain active until the maturity of the tenure of the investment period. So that means if they have an account prior to the change of their status as an NRI or an HUF, then that particular account can be extended to the tenure of 15 years. But once it will get the maturity, then it cannot be extended for further lock-in periods that we had discussed in the previous section. So the NRIs and HUF may not be eligible for opening the account, but if they have a prior account before the change of their status, then that account will remain active until the maturity. Now let us discuss the various schemes. So here we can see lock-in period is 15 years. Interest rate that you can get in a PPF account is 7.1%. Investment is very low. You can invest 500 rupees per year or a maximum of 1.5 lakh rupees, and this will also be exempted from taxable liability. And maturity may varies for the different types of investor, but at minimum we have a 15 years of maturity lock-in period into the investment into the PPF account. If we talk about the risk profile, so risk is very low as compared to the other investment avenues in the security market and the money market instrument that we had discussed in the previous lectures. As the PPF accounts are government backed securities, it is considered as a low risk investment option that also offers you the regular and fixed interest that is backed by the government of India. So for all the categories of the investors who come into the risk averse category, they can find this particular option as a suitable option for their investment of their money. Now let us understand how the interest rate that you get from the PPF investment is decided. So the interest rate on PPF account is basically decided by the central government of India, as the scheme is backed by the government of India. The current interest rate is 7.1% per annum. That is again subject to quarterly revision by the government of India. So in every quarter the government of India revises the percentage of interest that the investor will earn with the help of opening the PPF account, and the interest is credited annually in the PPF account on 31st March by the banking companies to the account of the investors. So basically the interest rate is decided by the government of India, and in every quarter it is revised also for the purpose of maximizing the benefits of the investor. But current rate of interest in case of the PPF account is 7.1%. Now let us understand the another benefit, the loan against the PPF, how you can ask for loan approval with the help of keeping your PPF account as a collateral security. So from the third year of the investment to the sixth year, you can apply and avail the loan with the help of your PPF account. The maximum loan amount is 25% of the balance at the end of the second year by proceeding the loan application. That means in the third year when you will apply for the loan, your loan value will be calculated from the 25% of the balance at the end of the second year preceding the loan application. The interest rate that will be charged on the loan will be 1% per annum. So very minimum amount of interest of 1% is charged by the banking companies for giving loan with the help of PPF account, and loan repayment must be done within 36 months. That is the 3 years of the time period. Within 36 months you need to repay the amount of loan taken under the PPF scheme. If you failure to repay your loan within this period, this will increase the interest rate to 6%. So the 1% rate of interest will be increased to 6% if at the time of maturity you will not be going to pay the principal as well as the interest amount of the loan that is taken by the PPF account. So loan facility is an important criteria of deciding whether we should invest into the PPF account or not, as in the cases of financial crisis, this gives you an opportunity of maximizing your potential for procuring the finances from the various sources of money. So here you can get a loan from the bank on a very minimum interest charge of 1% per year with the help of your PPF account. Now let us see the procedure for withdrawal from PPF. We have discussed in the lock-in period that there is a maximum of 15 years of lock-in period before which the overall, or you can say the maturity or the principal amount cannot be withdrawn, but partial withdrawal is allowed in case of the PPF account. So you can obtain a PPF withdrawal application form, Form C or Form 3 from your bank or a post office. You need to fill in the form with the required details that are asked by the bank, and you need to submit it to the respective branch where your PPF account is maintained. So where you can open the PPF account, the question comes. So PPF accounts can be opened at the post office branches, the participating banks. So many of the banks such as Bank of Baroda, Axis Bank, Kotak Mahindra Bank, Punjab National Bank and SBI and other banks are providing the facility of PPF to their investors. So on these different banks branches, you can open your bank account. Now let us understand some of the drawbacks of the PPF account. If we talk about the drawback, so what are the various limitations of investing your money into the PPF account? Let us understand that. It is having a very long lock-in period. That means your money will be illiquid for a total time period of 15 years and liquidity will be very low. Premature withdrawal is also not allowed, and minimum of 5 years of time must be completed for the premature withdrawal of money from the account. So under certain conditions only and with restrictions only you can withdraw your money from the investment of the PPF account. So this can pose a great financial risk for you if you are investing into the PPF account. Then comes the moderate interest rate. As compared to the other investment option, the interest is low to moderate in case of the PPF account. If we compare it with the other investment avenues that are available into the security market, that is the secondary market and money market instrument, they can give you higher rate of interest as compared to the PPF account. Then comes the next drawback, that is the individual holdings only. In case of PPF account, you cannot open a joint account, and again this poses some risk. If in case of the demise of the account holder, only the nominee will get the maturity amount, but he will not be able to operate that account further for investing the money with the help of the PPF account. So only individual account can be opened, no joint accounts are allowed in case of the PPF account. Then comes the investment caps. A maximum of 7.5 lakh rupees has been kept as an investment cap in the PPF account, and it can be invested per year, limiting the high value investment. That means you cannot increase your investment from a minimum level of 1.5 lakh into the PPF account of yours, and this will be the maximum limit of investment. Then comes the annual contribution requirement. That means the PPF account mandates it's that a minimum annual contribution must be made into the PPF account to keep your account active, failing to which the penalties can be imposed on you, and you need to contribute the minimum account, and if you do not do so, then it can lead your account to become inactive, and reactivating for your account, it may require you paying some amount of penalty. So in any case, if you forgot to invest into the PPF account, then it may charge you some financial penalties from the banking companies also. Now let us understand the process to open the PPF account. For opening a PPF account with the help of the digital platform, you need to follow these steps as we are going to discuss. In step number 1, you need to log in into your bank account with the help of the internet banking or with the help of a mobile banking platform. So with the help of internet banking or mobile banking platform, first by providing your login details, you need to log in into the account. In this step 2, you need to click on the link of open a PPF account option. In this step 3, if the account is for self, click self account option, and if you are opening it for any minor, then you need to select the option of minor account. If you are working on behalf of a minor, then you need to click on the option of minor account. So two options are available there, self account or minor account, as the case may be, you need to click the option. In this step 4, you need to enter the relevant details in the application form, such as your name, your address, other details regarding the KYC documentation may be asked by the bank. So you need to provide with all the details. In the step 5, key in the total amount you want to deposit, you need to enter the total amount of deposit that you want to contribute in every financial year in the PPF account. So here you need to give an information that what amount of contribution you want to make on a per annum basis in your PPF account. In the next step, you need to submit the application. Then at the time of submission, an OTP will be sent to your email ID or on your registered number. So with the help of receiving that OTP from the bank, you can enter it into the relevant field, and finally your form will be submitted. In this step 7, your PPF account will get created in an instant, and your PPF account number will be displayed on the screen, and also the bank will send you an email and your on the registered email address for the purpose of confirming the details regarding your PPF account. So this is the procedure of opening the online PPF account that you can follow. Now let us understand the process of transferring a PPF account from one bank to the another, or from one post office to the another post office. For the ease and convenience purpose, sometimes you may require to transfer your PPF account from one bank to the another. So in order to transfer the PPF to other bank account, you need to follow this procedure. First, you need to go to the bank as well as the post office branch where your account is going to be opened now. So where you want to transfer your account, you need to visit that branch. You need to take an application form from the bank, and you need to provide with all the required details asked in the application form for transferring your account. After that, you need to submit the account by attaching all the necessary documentation required to complete the transfer procedure of your PPF account. So the information regarding your Aadhaar number, PAN card number along with the application form may be asked by the bank or the post office branch for the transfer of your account. After the submission, verification is done. So once you have filled out the form and submitted it, the form will go through a verification procedure, and accuracy of all the details will be verified with the bank to ensure your KYC details, and then transfer processing will be done. So once the verification is completed, your existing bank or post office will process your application for transfer, and your transfer of account in the new branch will be done by the new branch. So this is the procedure of transfer. And you can also attach your PPF account with your other bank account. So one of the major advantage of investing into PPF account is that your account balance in the saving account can't be used to pay off your outstanding liability if you transfer your balances from saving account to the PPF account. That means that no court order can give a decree that PPF account can be attached with the saving bank account to pay off your debtors, and only exception is that it does not applies to the income tax authority. That means if any taxes to be deposited, then only the PPF account can be attached with your saving bank account to pay out your debts or outstanding liabilities regarding the income tax authorities. So this is a comparative analysis of the PPF and mutual fund investment. PPF gives you a low risk investment option, whereas mutual fund is a market driven investment option, so risk can be low to moderate. It has a lock-in period of 15 years, whereas in case of mutual fund it is open-ended scheme, and many other types of schemes are available. So as per your liquidity requirements, you can choose any of these schemes to maintain your contribution. It has a fixed rate of return, whereas the return in case of mutual fund investment depends on the market performance of the stocks or the financial instrument that have been chosen into your portfolio. So this is a comparative analysis. With this, you can very easily compare and decide in which investment option you want to contribute your savings. Now, with the end of this particular lecture, I hope you are now capable of understanding that there are multiple tax saving schemes of the government that offers you regular return, as well as the tax saving may be also possible by contributing in these schemes. So for managing your personal finance efficiently, you can invest into these types of investment avenues, and you can secure your financial future. With this, we come to an end of this lecture. Thank you.